Hey everyone, it's Jason from MAPsignals coming at you with the 4 best recession ETFs for the month of August. Let's just get to it. First things first, let's just do a 90-second market check-in. So the big money index went oversold May 23rd, and then subsequently the market had a significant rise. I'm going to go over here in my MAPsignals portal. I'm going to switch this to the Qs, which is the NASDAQ tracking ETF. Let's look, May 23rd, we went oversold. The NASDAQ subsequently rallied 9.5%. And then the big money index went oversold again on July 14th, and the NASDAQ subsequently rallied 7.5%. That oversold indicator, very reliable, going back 32 years. This big money index is indicating money is flowing back into the market, albeit not on huge volume, a BMI of 44 and rising. But really, what are we seeing? We saw this huge selling. These are stocks. All the selling in November, in January, in March, in May, and again in June. Now the selling has just been vanishing. Let's zoom in on that. Look, the last 3 months, very few selling indicators, and we're seeing the same with ETFs. Monster selling until recently, very little and just tiny little buying. So market setting up interesting. The Fed today announced an interest rate hike of 75 basis points. We are now at 2.5%. There's more clarity. Core inflation is falling. And even though the price at the pump and food is still high, we're getting clarity from the Fed, which sets up for stocks quite well. I believe we're going to see a fourth quarter lift. And what stocks are getting bought right now? We're seeing some growth stocks and tech stocks, so that gets me excited. So let's get to our 4 ETFs. So I'm going to head over here to my ETF module. This is in beta. You can't see it yet if you're a MAPsignals member, but soon we're going to clean it all up and make it look nice and stick my face over here. But you get the top 20 ranked ETFs based on their constituents, all the stocks inside, and you get to see the percentage, that's 99% coverage in FCG, the MAP score overall, which is strong, 68.4, fundamental, 62.3, and technical, 72. You get to see all of these for the top 20. What you will notice right away is a bunch of these are energy and healthcare, and that's where we're seeing a lot of our opportunities. So let's just head right over to our first ETF, MLPX. This is a MLP ETF, typically very high dividend paying stocks and typically energy. Look at the constituents. All these stocks are energy. Now, what you will notice if I head over here to our ticker map just to look at a chart, we're not going to see tons of big money buy signals. And that is because, I'm going to move my face again, that is because this stock, this ETF rather, has low volume. It only trades 186,000 shares per day. It does have $909 million under assets. But the fascinating thing is this thing has a monster yield. You want yield in a recession? This one's got it. 6.06% dividend yield, and it's got excellent stocks in it, such as LNG. So let's take a look at LNG, which is Cheniere Energy. This stock has been seeing a lot of big money buying, a 72 score overall, 82 technical, so money's flowing in. Fundamentals are reasonably strong. They make liquid natural gas, and if you've seen anything about natural gas in the past 3 days, it's been rallying through the roof, which translates to potential bigger margins. Now look at this big money buying going all the way back to November. It did pull back in June, and it has bounced back since. Sports great fundamentals for the most part. 1 year and 3 year great sales growth, 1 year earnings growth, 3 year earnings growth not so great, but it does have very little debt, and margins should be expanding and earnings should be solid for the next couple of quarters. So Cheniere Energy, part of MLPX. Heading back over to our ETF module to scan this top 20 list. Once again, we see a bunch of energy and healthcare stocks. Now, XLV, we went over recently. It's down here. We got some other healthcare ETFs. PINK is one, lower volume. But let's look at IYH. It's an iShares healthcare ETF. You should know this one is not particularly liquid either, trades only about 58,000 shares. It does have 2.84 billion in assets, however, and it does sport a 1.12% yield. So it is in the healthcare world. Let's check out some of these stocks that are in it. It's got great stocks. The biggest weighted stock in it is United Healthcare, 9.73. But look here. Let's just take a quick look at the chart. You will not see big money signals because it does not sport huge volume. It's been kind of chop city, but there's been a lot of money flowing into healthcare and specifically great stocks such as Johnson & Johnson. You have many of their products likely in your bathroom cabinet right now. It's a long time great stock. It's ranked 65.5. Solid, good technicals, great fundamentals. Seeing big money buying, lifting this stock. It did sell off in June like everything. You got 1 year sales growth of 13.5%, 3 year sales growth of almost 5%, 1 and 3 year earnings growth great, a solid profit margin of 22%, and only a reasonable debt level of 47%, a reasonable PE ratio of 17 rather. That's Johnson & Johnson in IYH. Back to our ETF list. I told you there's a lot of energy. Look at that FCG, MLPA, MLPX. Those are all energy, FXN, etc. But this one caught my eye. XOP. It is an oil and gas exploration ETF, and it boasts, obviously, huge energy stocks. Don't get thrown off by TPL. It is technically a financials company, but in the energy space. And this thing boasts some pretty rockin' stocks. Now, the thing you should know about XOP, it trades 8 million shares a day, so it is plenty of volume, which we'll see in a moment with these signals. Let's jump on over there as we do that. It has $4.2 billion under management, and it boasts a 0.92% dividend yield, so just under 1%. You can look at this big money buying that was happening fall of last year, and then spring of this year. It had a big run up and a big pullback, which gives us an interesting opportunity here. One of the stocks in there is a monster. We might have even gone over it recently. That is Coterra Energy. This thing has been on the top 20 recently. You can see it over here, these blue bars. That's our best of best report. It's been appearing there. You see this big money buying, lifting the stock higher, pulled back with everything in July. 1 year sales growth, 3 year sales growth, phenomenal. 1 year earnings growth, not so great, but 3 year earnings growth, 106%, a profit margin of 31%, a debt to equity ratio, very reasonable, 29%. This thing has a 6 PE. Talk about low, huge prices at the pump. It's going to translate to big margins for these energy stocks as they continue rocking. XOP. One final visit to our ETF list has us talking about a weird one. Not weird, it's just off the run. We don't see it very often. It is low liquidity, so please keep this in mind if you are going to be considering these for yourselves. Liquidity has a lot to do with it. If it doesn't trade a lot of shares, it can be very volatile. But this one caught my eye. QMOM makes me think of mom. Hi, mom. If you're out there, very strong. It's got 97.5% of the stocks that score, 64% overall, a 60 fundamental, and a 67% technicals. Why do we like it? Well, it is a momentum-based ETF with a lot of stocks that are seeing influx of momentum. And if you've been following the market recently, you know people are buying staple stocks, they're buying energy stocks and healthcare stocks. This ETF is loaded with the stocks that are going up right now. Now, if we look at the chart, you'll notice it is kind of choppy because the market overall has been very choppy, and there have been a lot of rotations. Hi, Mom, QMOM. So you get this choppy action. You're not going to see any signals. Why? Because this thing only trades 10,000 shares a day. So please beware. It does sport a 1.24% yield, but it only has 91 million under management, $91 million. But why do I like it? Why do I like QMOM? Let's go back. We're going to look. It's got great stocks in here. BJ's, you've heard about it. Dollar Tree, Costco, OPCH is a healthcare name I'm very familiar with. Lilly, great stocks in here. But let's look at this one, CalMain Foods. Right here, you can see the score, 84.5. Let's actually look at that in our map view module. CalMain specializes in eggs. They make eggs production and distribution, and eggs right now are very expensive because of grain prices, etc. Again, translating to higher margins. 84.5 overall score. Technically, it's extended because people are buying it, but very solid fundamentals, 83.35. So let's look at it. You see this big money buying in clumps happen in March, pulled back, happened again recently. It's been a top 20 stock quite recently as well. Let's look at these fundamentals. 1-year sales growth and 3-year sales growth, very solid numbers. A 1-year earnings growth, not so good, but 3-year earnings growth, 2,000%. And a profit margin of 7.5 with hardly any debt and a low PE of just over 10. CalMain Foods as part of QMOM. Hi, Mom. So there's your momentum-based ETF. There you have it, the 4 best recession ETFs for the month of August. We have MLPX, IYH, XOP, and QMOM. If you like what you saw today, please like and subscribe. By all means, leave comments below so we can get better and let us know what you think of stuff like this. Remember, there's opportunity everywhere, and these are the ETFs that MAPsignals is finding. If you want more information, head over to the website, sign up for the blog. I will see you next time. Thanks. Bye.